Did you know that nearly half of the UK's GDP comes from foreign investment? That's right, billions of pounds flowing into the economy from outside the country. But here's the kicker. Is this a good thing, or is the UK becoming dangerously dependent on money from abroad? Imagine this. One day, a foreign investor could pull their funds out, and just like that, the UK's economy could take a massive hit. We've seen countries crumble under the weight of foreign reliance before, but is the UK walking the same tightrope? In this video, we're going to reveal 10 surprising reasons why the UK's economy might be relying too much on foreign investment, from job creation and economic stability to concerns over national security and wealth inequality. There are some huge questions that need to be asked. What happens when foreign money controls too much of a country's assets? Could it be making the UK vulnerable to global market crashes? Or are these foreign investors the unsung heroes that keep the UK afloat? By the end of this video, you'll be questioning just how much power foreign investors should have over the UK economy. Get ready for a deep dive into these shocking realities that could change the way you view the economy forever. Number 1. Economic growth and job creation. Foreign investment plays a pivotal role in driving economic growth in the UK, and one of the most visible impacts is the creation of jobs. When foreign companies invest in the UK, they bring in capital, resources, and sometimes even new technology, which helps boost productivity. This influx of foreign money often leads to the development of new industries and the expansion of existing ones, creating opportunities for the workforce. Take the tech industry, for example. Companies like Google, Amazon, and Apple have made substantial investments in the UK, building headquarters, data centers, and research hubs. This not only creates thousands of high-paying jobs, but also sparks innovation, drawing in talent from all over the world. As foreign companies set up shop, they require local employees in fields like marketing, IT, finance, and operations, further adding to the pool of job opportunities available. The real estate sector is another area where foreign investment has made a noticeable difference. Foreign buyers, particularly from countries like China, the US, and the Middle East, have purchased large properties in major cities like London. This has fueled a housing boom, providing construction jobs and fueling demand for real estate services. Moreover, foreign investment doesn't just create direct jobs, it also has a ripple effect. For example, when an international company invests in a factory or retail business, it often leads to an increase in demand for local suppliers, transport services, and other businesses that depend on the success of the initial investment. While foreign investment is undeniably a major contributor to economic growth and job creation, there is a catch. The growth driven by foreign investors is often not evenly distributed, and much of the wealth generated can end up in the hands of foreign stakeholders rather than staying within the UK economy. Number 2. Economic stability. Foreign investment is often seen as a stabilizing force for the UK economy, especially during times of uncertainty or financial turbulence. The influx of capital from international investors helps diversify the country's economic base, providing a buffer against domestic economic fluctuations. When the UK faces challenges such as recessions, trade disruptions, or political instability, foreign investments can offer much-needed financial stability. For instance, during the 2008 financial crisis, the UK economy was hit hard. However, foreign investment acted as a lifeline, helping to shore up businesses and banks that might have otherwise failed. In such times, foreign investors often step in, either by purchasing distressed assets or providing liquidity, which helps avoid deeper economic downturns. Their willingness to invest in the UK during turbulent times demonstrates the confidence they have in the country's long-term stability, even when short-term conditions are challenging. Moreover, foreign investment brings not only capital, but also global connections. Companies investing in the UK often have global networks and markets, which can help UK businesses weather economic storms. The presence of foreign investors also means that UK businesses have more opportunities to expand internationally, reducing their dependence on domestic markets that might be struggling. But while foreign investment can provide a cushion during tough times, it also creates a dependency on external factors. The risk here is that if international markets experience a downturn, or if foreign investors decide to pull their funds out, the UK could be left vulnerable. So while foreign capital brings stability, it also brings with it a reliance on the broader global economy, which can be unpredictable and volatile. In short, while foreign investment helps maintain economic stability, it also raises questions about the UK's reliance on external forces to keep its economy afloat. Number 3. Dependence on volatile global markets. While foreign investment has its benefits, one of the significant risks is the UK's growing dependence on volatile global markets. The reality is that when foreign capital flows into a country, it often comes with its own set of risks, especially when the global economy experiences turbulence. For example, during periods of global recession, investors may decide to pull back or withdraw their funds from markets they perceive as risky. This can lead to sudden capital outflows, shaking the UK's economic stability. If foreign investors lose confidence due to a global financial crisis or geopolitical events, it can send shockwaves through the UK economy, potentially leading to job losses, declining asset values, and even economic slowdowns. Think back to the Brexit referendum in 2016. When the UK voted to leave the European Union, there was immediate uncertainty in global markets. Foreign investors were uncertain about the future, leading to a sharp decline in the value of the pound and a decrease in foreign investments in the UK. The stock market also saw fluctuations, with investors unsure about the UK's future trade relationships. This was a clear demonstration of how the UK's economy is intertwined with the global economy and how external shocks can have an outsized impact. Moreover, markets in emerging economies such as China and India can experience significant growth or downturns, which can also influence the flow of foreign capital. If these markets face a slowdown, it's possible that UK investors, who rely on global growth, may find their investments less profitable. This dependence on global trends makes the UK economy particularly vulnerable to events beyond its control. The volatility of foreign markets means that the UK's prosperity is increasingly tied to the whims of global investors, leaving the country open to sudden economic shifts. Number 4. Loss of control over strategic industries. One of the more alarming consequences of heavy foreign investment in the UK is the potential loss of control over critical and strategic industries. Key sectors that are vital to a nation's security and long-term prosperity, such as energy, defence, and infrastructure, are becoming increasingly owned or influenced by foreign entities. This growing foreign ownership poses risks not just to economic stability, but also to national security and sovereignty. Consider the energy sector. Over the years, foreign companies have acquired stakes in several of the UK's major energy providers. While this has allowed for technological advancements and financial support, it also means that a significant portion of the UK's energy infrastructure is now in the hands of foreign governments or corporations. Should these foreign stakeholders decide to cut off investments or shift their focus to other markets, the UK could face disruptions in energy supply or price volatility, severely affecting businesses and households alike. The defence industry is another area where foreign ownership can be concerning. If foreign investors gain significant control over defence-related companies, they could gain access to sensitive military technologies and strategies. This creates potential vulnerabilities in national defence systems, as decisions regarding production or research could be influenced by interests outside of the UK. Moreover, the rise in foreign ownership in infrastructure projects, such as transportation, telecommunications, and water systems, means that crucial assets could be subject to the whims of foreign investors, who may prioritise profit over the well-being of the public. The long-term consequences of this are concerning, as the UK might lose its ability to make independent decisions about its future in these vital areas. In essence, While foreign investment brings financial benefits, it also brings a gradual erosion of control over industries that are foundational to the country's long-term stability and security. Number 5. Inequality and wealth distribution. Foreign investment, while undoubtedly a driving force for economic growth, has a darker side when it comes to wealth distribution. One of the key concerns is that foreign capital often flows into industries and sectors that disproportionately benefit a small group of people, leaving many in the UK to face growing inequality. Take the real estate market, for instance. Foreign investors, particularly those from countries like China, the US, and the Middle East, have purchased high-value properties, especially in cities like London. While this inflow of foreign capital has helped fuel economic growth, it has also driven up property prices and made housing increasingly unaffordable for local residents. As a result, many UK citizens, especially first-time homebuyers, are left out of the housing market entirely, leading to an increase in rental prices and a rise in housing inequality. Similarly, foreign investment often targets high-value industries like finance, technology, and retail, where the rewards of growth are concentrated among top executives, shareholders, and international investors, rather than being distributed to average workers. While companies benefit from new capital and job creation, the profits often end up in the hands of foreign investors, or are repatriated to their home countries. This means that the local workforce doesn't always see a proportional benefit, leading to stagnant wages for many and a growing wealth gap within the country. This uneven distribution of wealth not only deepens economic inequality, but also strains the UK's social fabric. As more and more of the country's assets fall into foreign hands, questions arise about who truly benefits from the UK's economic growth. Is it the everyday citizens, or is it the foreign investors who come to the UK to capitalise on its prosperity? The answer could have long-term consequences for social cohesion and stability. If you found this video eye-opening, don't let it end here. Drop your thoughts in the comments. We'd love to hear your take on the UK's reliance on foreign investment. And hey, subscribing is just one click away. Help us keep delivering valuable insights straight to your feed. Number 6. Risk of asset stripping. One of the more troubling consequences of foreign investment is the potential for asset stripping, a practice where foreign investors purchase UK businesses, break them down for their valuable assets, and sell off the parts for short-term profit. While this may provide a temporary boost to the economy through initial investments, it can leave lasting damage and hurt the long-term sustainability of the businesses involved. For example, companies in industries like retail, manufacturing, and energy have often been targeted by foreign investors looking for quick returns. When they acquire these businesses, they may sell off key assets, such as factories, land, or intellectual property, to maximize their profits. In the process, thousands of local jobs can be lost, entire supply chains can be disrupted, and the value of the company itself can plummet. This may leave the UK economy weaker in the long run, as industries are left without a solid foundation for growth. A well-known example of asset stripping is the case of Britain's high street retailers. In some instances, foreign investment led to the closure of stores, layoffs, and the dismantling of local supply chains. The once thriving businesses were broken up, with valuable real estate sold off to the highest bidder, leaving communities devastated. The real issue is that this strategy doesn't always align with the long-term interests of the UK economy. While foreign investors might benefit in the short run, they don't have the same commitment to preserving the company's future success or supporting its local workforce. Instead, they often take the assets and move on, leaving behind an economy with fewer jobs and fewer opportunities for growth. So while foreign investment is crucial for economic vitality, the risk of asset stripping remains a major concern as it threatens to undermine the long-term health of the UK's economy. Number 7. Lack of investment in R&D. Foreign investment can be a double-edged sword when it comes to research and development, R&D. While foreign capital often fuels the growth of businesses and sectors, it can also result in a lack of long-term investment in innovation and technological advancements that are crucial for the future competitiveness of the UK economy. Many foreign investors are focused on short-term profits and quick returns rather than the long-term sustainability of the companies they invest in. As a result, they may be less inclined to prioritize spending on R&D, which can take years to show tangible results. In industries like pharmaceuticals, technology, and engineering, the focus should ideally be on continuous innovation, product development, and cutting-edge research. However, if foreign investors are primarily concerned with immediate financial gains, there is a risk that vital resources for R&D could be diverted elsewhere. Take the tech sector, for example. While foreign investors have helped fuel the growth of some UK tech companies, many of these businesses are still underfunded when it comes to investing in new technologies and developing homegrown solutions. As a result, the UK may fall behind in global innovation races, particularly in artificial intelligence, biotechnology, and clean energy, where R&D are paramount. Without proper investment in innovation, the country could miss out on creating the next generation of breakthrough technologies. Additionally, when foreign firms control UK companies, they often prioritize R&D efforts that serve their global strategies, leaving UK-specific needs or opportunities overlooked. This can stunt the development of innovations that are specifically relevant to the UK market or its economic future. In short, while foreign investment has helped to fuel some growth, the lack of long-term commitment to R&D could ultimately undermine the UK's future economic prospects and technological leadership on the global stage. Number 8. Impact on housing market. One of the most visible and controversial impacts of foreign investment on the UK economy is its effect on the housing market. In major cities like London, Manchester, and Edinburgh, foreign investors, particularly from countries like China, Russia, and the Middle East, have poured vast sums of money into purchasing high-end properties. While this influx of foreign capital may seem like a positive thing at first glance, it has led to significant consequences for the housing market and local residents. The most immediate effect is the soaring property prices. As wealthy foreign buyers snap up luxury homes and prime real estate, property values in these areas skyrocket, making them inaccessible to local people, especially first-time homebuyers. The rapid increase in property prices pushes many out of the housing market, forcing them to rent instead of buy. This can lead to a housing crisis where middle and lower income families are unable to afford homes in the cities where they live and work. In addition to driving up prices, foreign investment has also caused a housing supply imbalance. Large-scale property developers may focus on building luxury apartments and high-end homes, which generate the highest profits. As a result, there is less emphasis on building affordable homes for the local population, exacerbating the shortage of housing available for those who need it most. Moreover, foreign buyers are often more interested in investment properties rather than using them as primary residences. This has led to the rise of empty homes in desirable neighbourhoods, with entire buildings or blocks of flats sitting vacant for months or even years, while local residents struggle to find affordable housing. The consequences of foreign investment in the housing market are clear. While it boosts the economy in the short term, it also makes it harder for ordinary people to access the housing they need, increasing inequality and social tensions in the process. Number 9. Currency risks and exchange rate instability. Foreign investment in the UK is closely tied to global financial markets, and with that connection comes a significant risk: currency fluctuations. The UK's economy can be heavily impacted by sudden changes in the value of the pound as foreign investors move their capital in and out of the country. These shifts in currency exchange rates can create economic instability and affect businesses, consumers, and even government policy. When foreign investors bring capital into the UK, they often need to exchange their money into pounds. However, Fluctuations in the value of the pound, whether due to economic uncertainty, political changes, or broader global events, can cause the pound to either strengthen or weaken unexpectedly. This volatility can make foreign investments less attractive, as it increases the risk of currency losses for investors. In turn, this could lead to a reduction in foreign investment if investors feel uncertain about the stability of the pound. For example, following the Brexit referendum in 2016, the pound dropped sharply in value against other major currencies, creating a currency crisis. While this might have been an opportunity for foreign investors to buy UK assets at lower prices, it also raised concerns about the stability of the economy, leading some investors to hold off or even pull out their capital. Furthermore, businesses in the UK that rely on international trade are highly sensitive to these changes in currency value. A weakened pound makes UK exports more affordable for foreign buyers, which can be a positive in the short term. However, it also increases the cost of importing goods and services from abroad, putting pressure on businesses that depend on foreign materials or products. This can lead to inflation, higher production costs, and squeezed profit margins for UK companies, affecting consumers as well. In short, while foreign investment can stimulate economic growth, the associated currency risks and exchange rate instability can make the UK economy more vulnerable to global financial shifts, creating uncertainty for businesses and citizens alike. Number 10. Political influence and external pressure. As foreign investment continues to grow in the UK, there is an increasing risk of political influence from external forces. Foreign investors often hold significant financial stakes in key sectors such as energy, technology, and finance, and their interests can sometimes conflict with the priorities of the UK government or its citizens. This power dynamic can lead to a situation where decisions that affect the nation's economy, infrastructure, and even national security are shaped by foreign entities rather than the needs of the people who live there. A prime example of this is the growing presence of foreign investors in the telecommunications and energy sectors. With foreign companies investing in or owning key infrastructure, there's a risk that these entities might exert influence on government policies or regulatory decisions. Foreign investors may lobby for favourable regulations, tax breaks, or other policies that benefit their interests, even if they don't align with the long-term interests of the UK's citizens or economy. This could lead to compromises that prioritise profits over public welfare, such as less stringent environmental standards or reduced worker protections. Additionally, foreign investment in defence and security-related industries presents a unique set of challenges. When foreign investors own or hold significant stakes in defence contractors or critical infrastructure, there is the potential for these companies to be swayed by political considerations from their home countries. In extreme cases, this could even lead to national security risks, as foreign governments may seek to influence policies or restrict access to critical information, technologies, or resources. This growing political influence can also lead to external pressure on the UK government, especially in the context of international trade deals and economic relations. Foreign investors may push for the government to make decisions that benefit their home countries, potentially at the expense of the UK's domestic priorities or values. In essence, while foreign investment helps stimulate economic growth, it also introduces the potential for political interference. This raises important questions about the extent to which external forces should be allowed to influence a nation's policies, particularly when national sovereignty and security are at stake. In conclusion, while foreign investment undeniably brings significant benefits to the UK, such as economic growth, job creation, and stability, it also introduces a series of complex challenges. From inequality and loss of control over strategic industries to currency risks and political influence, the UK's growing reliance on foreign capital may be creating vulnerabilities that could have long-lasting consequences. The country is at a critical juncture where the benefits of foreign investment must be weighed against the risks that come with it. As we've seen, The influx of foreign capital can improve the economy in the short term, but also makes the country more susceptible to external shocks, wealth disparity, and a potential loss of sovereignty. Therefore, the key question remains: how can the UK maintain its economic strength without becoming overly dependent on external forces? To address the growing concerns surrounding foreign investment and its potential negative impact on the UK economy, there are several strategies the government and businesses can adopt to strike a balance between attracting foreign capital and maintaining economic independence. Encourage long-term investment in R&D. To ensure the country's future competitiveness, the UK should prioritise foreign investments that focus on research and development, R&D, and technological innovation. This could involve creating incentives for foreign companies to invest in industries like clean energy, artificial intelligence, and biotechnology, which will help secure the UK's place as a global leader in innovation. The government should implement policies that ensure critical industries, such as defence, energy, and telecommunications, are not completely controlled by foreign investors. This might include stricter regulations and national security reviews to protect these sectors from falling into the hands of foreign interests that may not have the UK's long-term stability in mind. To reduce over-reliance on foreign capital, the UK should encourage domestic investment in key sectors. The government could introduce tax incentives and policies aimed at fostering homegrown businesses and encouraging UK-based companies to reinvest their profits back into the economy, particularly in areas such as infrastructure, education, and healthcare. To mitigate the risk of currency fluctuations, the UK must work to diversify its foreign trade relationships and create stable economic policies that can withstand shocks from global financial markets. This includes making the pound less vulnerable to sudden shifts and ensuring that domestic businesses can thrive even in times of global economic instability. The government should introduce measures that limit foreign speculation in the housing market, such as imposing higher taxes or restrictions on buying properties that are left vacant for long periods. This would allow for more affordable housing for UK residents and ensure that local communities benefit from the country's economic growth. By adopting these measures, the UK can continue to reap the benefits of foreign investment while safeguarding its economic future and national interests. The key is finding a balance between attracting global capital and ensuring that the country remains self-sufficient and resilient in the face of an ever-changing global landscape. If you found this video insightful, we'd love to hear your thoughts in the comments. How do you feel about the UK's reliance on foreign investment? Share your perspective with us. And don't forget to check out our previous video for more deep dives into critical topics. We put a lot of effort into bringing you the best content, so please subscribe. It's just one click and helps us keep producing valuable videos. Your support means the world to us.